All right, stocks finished the week on a high note thanks to a couple of areas that did really, really well today. Banks with earnings, Disney, consumer discretionary, even though Netflix not necessarily doing as well. So weighing down on that communication services, but still, a really, really good week for those cyclical areas. Nice rebounding week for financials. So we're going to break down now, okay, how much, does that impact how much longer we expect this little bit of a rally to last, and, where we can get to, and how it's going to look like, and where have we seen this type of pattern before. So giving you some context on what we can expect, the type of patterns we can expect. So I'm going to break all that down in today's video and take a look at a stock that finally kind of showed up to the party this week, and see how we can trade it. So let's go ahead and get started. Today is Friday, April the 12th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500, as always, with the market forecast indicator, and you see the nice, good little breakout move. So yesterday I talked about this little 20 point on the SPX range that we had over 5 days. Well, today, we broke out, thanks to Disney largely, but other things too, and nice banks mainly. We'll talk about that later in the video, but nice, good breakout here. Up to 2907. So we talked about, we had, and yesterday I mentioned that we had the possibility of getting up towards 2900, or, closer up to these. So we still got 2940 is where the highs are, but getting up towards 2900, we still had some room to go up higher, at least in the short term, before we had any kind of like major pullback or intermediate pullback where the green line falls back down below 50. And so we're still playing this. I mean, look at this run that we've had. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Out of the last 12 trading sessions, 11 of those have been to the upside. So it's been kind of a nice little rally. I mean, not exactly what it looked like back in late 2017, early 2018, when the market just went up like every single day, and then February hit. Not the exact same extent, but still pretty darn bullish here. You can see obviously the intermediate line is still up above 80. The market sentiment line is still up above 80. Near term line has bounced up into the reversal zone, has still not bounced up to a new high. So it's obviously lower than the previous near term high, because that's, we did drop below 50 right there. So there's the previous near term high. We're obviously below that. The index itself is obviously above that because we broke out today. So momentum line also bounced up, but not because of the gap. I mean, if we didn't have the gap there and we gapped up, we were closed at 28.88 yesterday. Today's low is at 28.98. So you had 10 points there. We really had you add 10 points to that daily range, and we did hit the average ATR. So we probably would have had a little bit higher of a momentum line had you had that gap incorporated. It just looks at the range and sees that 12-point range and moves higher because we're up, but doesn't go all the way up to the top because it was a very small range compared to the average, especially more recent average. And so, pretty darn bullish. Came close to a cluster. It would be a first cluster for this index. You look at the Dow Jones Industrial Average, has not broken out above those highs yet, but nice, good bullish move today, and also coming close to a quadruple cluster here. Only the near-term line in this case was the one. It had a much bigger gap, and that helped the momentum line get a little bit higher. But the near-term line was the one. It had a much lower point to come up from yesterday because we had deeper of a pullback. Again, context, right? It wasn't that deep of a pullback, but deeper than what the S&P had shown. And then you see the NASDAQ not nearly as bull. I mean, it was up 0.46%, but you see the near-term line actually dropped. And it's still in the process of forming that divergence we talked about yesterday. Momentum line bouncing, but sitting right around the chart's midpoint. Very, very small ranges, as you can see on the chart. And then finally, the Russell 2000. If you took a Russell 2000, you notice that it did also break above the highs, not nearly to the same extent. Very, very small range. You can see it closed 1579 yesterday. It closed at 1584, so it did have a little bit of an upward move. You don't see that up there, but and it's close to a cluster. But the momentum line, because of the really small ranges, the last couple of days has really dropped down. Not to extreme lows, so it's not too bearish, but you also still have the bearish divergence, slight bearish divergence set up on this. Remember, the Russell's been a lot more sideways, more of the pullback we expect to see in the other indexes than what we've seen so far, because the Nasdaq's been so bullish, and then of course the Dow has also had its period of bullishness and underperformance thanks to Boeing, and then the S&P 500, which is pushing up really well and pushing up higher. So that's what we got going on right now on the market forecast studies for these. So still strong bullish trends, dark green shading, dark green lines. 3 months in, right? We're 3 months in. We're still off of this divergent low point, this higher low, and we expected to get to a higher high. We expected that we would, eventually reach this 2,900 plus area, and we've reached that now. We're getting more signs, more kind of red flag signs that we might be towards the end of this intermediate run, but it's not going to end on Monday, right? That intermediate runs don't end in a day, unless you're, even on this day right here, we were already below 50 by the time, right there, we were already below 50 by the time we got those 2 days, right? So intermediate runs don't end, especially from as high as we are in a single day. So we'll continue to grind. But just keep in mind the length of this intermediate run that we're currently on, how long we've been above 50, and how long we typically stay above 50, which is, 3 months on the long end of things, which is where we're at. And we've seen in the past, a couple of times in the past, when we go longer, we get bigger pullbacks. All right, before we look at some other charts, a reminder, subscribe to our YouTube channel. There's usually a logo here in the bottom right corner of your screen. We don't see it here, but they're usually, because I'm not signed in, but there's usually a logo right there in the bottom right corner of your screen. Mouse over that logo, and then hit the red subscribe button. There's also this subscribe button right here. Click on that. That will get you notified when these videos are posted. Also, click this thumbs up icon right here. That lets us know that you like the video, number one. Number two, it's a really easy way to tell us you want us to do the video again on Monday. So as we do these things, as we post things on social media, the way you tell us that you want us to keep doing it is you just hit these likes. It's really important to us, as it shows YouTube that these are engaging pieces of content. That's why we ask you. But it's also a good thing for you, because it tells YouTube and Twitter and Facebook and whatever else that you want them to keep showing you our stuff and promoting our stuff because you engage with it. Finally, comment down here on anything that stands out to you from the video here tonight. Join our daily Market Outlook email list. There's this form right here in the bottom of the video. If you just scroll down on the blog, easy form, first name, last name, email address, click the sign up button. Very, very easy way to sign up. Remember, this email that you get has a timestamp summary of the videos here. These are hyperlinked. It takes you straight to these segments. So make sure if you can always go back and listen to repeat segments. UNH sure turned out to be a pretty decent trade today. There's also links to the video as well as these lists, right? So today's will actually have the daily and the weekly clusters list. So make sure you scroll down to the bottom of the email to get that. Follow me on Twitter for more content throughout the day that Brandon and I put out there. So make sure you follow me at DavidSettle42. And then join our Market Outlook community that we've created here on Facebook. Again, it's just facebook.com/group/Market Outlook up here, and that will get you to our group, and you get to join this group and see the content that we're putting out, and also be able to engage with other market scholars that are part of this community too. All right, let's get back to the charts, and let's take a look at the long-term view. So now the weekly chart is over, and a nice, not as big of a range, but today's rally helped widen it out a little bit. And of course, the Heikin-Ashi candle looked nice and bullish. Again, remember that the high of this shadow is the high of the week. The close of the Heikin-Ashi candle is the average of this week's high-low open and close. So sometimes you might get higher highs but not higher closes on the Heikin-Ashi, and that's not as big of a deal. Even though it's nice to get the higher closes, you see how we're progressively moving up. And remember, the midpoint of this body will be the open for next week's candle. So we're gonna, as of right now, that's gonna be right around this eyeballing at right around 28.68, and we're trading up at 29.07. So we're gonna start off with a pretty decent, which 29.07 is already above this week's close at 28.94. So we're already starting out next week Depending upon where we open on Monday, and assuming we open right around here at 29.07, we'll already be starting out with a pretty decent bullish Heikin-Ashi candle for next week. Let's take a look at the 3 green arrow chart, and you see obviously 3 green arrows, green line. I didn't take a look at the market forecast on the weekly chart. Let's take a quick look at that on the weekly here, and you see that we've had the dark green shading for a while. The intermediate line has turned up higher, but you notice now we got the dark green line. The moving average, which is the 30-week moving average, has finally turned up. Well, it turned up last week, and that's why it's turned green, and it will continue to be higher next week. So again, to kind of see what that looks like on a weekly chart, you can see what the long-term charts can be. You see the intermediate run. This intermediate run lasted for multiple years, right, from early 2016, March 2016 to April of 2018 by the time we finally got the intermediate line below 50 there. And we had one smaller run here that didn't last as long, and obviously the lower low. And right now you can see we're on a new intermediate run, but still not above that high. But you see how long it took. We did get above that high over here, just barely, and then we finally got this kind of weaker pullback at the end of 2016, right before the election. So on a daily chart, it looked a lot weaker. You can see here on the daily chart, that time frame right there looked a lot weaker, right? It brought the intermediate line, it produced a cluster right before the election. Bearish, dark pink shading, red lines. On a weekly chart, it kind of gives you a different perspective, right? It just barely came down to the moving average, dipped below it for 1 week before bouncing right back up above it, and then away we went after that. So we're kind of in that mode right now where we have the chance of getting up above this, and once we do, we might get more of an extended pullback that we've been waiting for before we bounce off of what would be now a rising this would be a 30-week moving average, and then start a new move higher, however long it lasts, right? This was a very, very long market rally that was fueled by tax reform here at the end. So we'll see, even if we might get a run like this afterwards, after a pullback like we had in late 2016, that wouldn't be out of the realm of possibility at all. So let's go back to the 3 green arrow charts, and then look at the weekly chart for that, and you can see the same thing, 3 green arrows, and now you have that moving average. Again, very similar to what we saw over here, where we got 3 green arrows, and moving average finally turned up right there, and then it kind of flattened out, and then we moved up to new highs, and then we had the retest, right, and the 3 red arrow signal that produced a low point, and we bounced off of it. Same thing here, 3 red arrow signal produced a low point that we hammered around for a while and bounced off of it, and here's a 3 red arrow signal where we didn't, right, and we fell down. We got the red line there. So it looks like we're kind of in this mode here again on the S&P on the long-term chart. When you break down the S&P, those 3 lines break those down into their individual lines, you can see we are pretty bullish now. So we are maturely bullish. If we do move higher, it's going to grind. It's not going to be a nice, good rally. Today's move notwithstanding, it was a nice move today, but it's small potatoes compared to the rally we've had to get to this point. So we're just kind of, a little bit here and a little bit there, more to the upside because that's the trend. But also keep in mind that, again, similar to what we saw over here, we're kind of in this mode where they're all crossing, and we've crossed up above. We're pretty high on this momentum here, especially relative to these other times that we were pretty bullish at same price levels before we ran out of gas on the daily chart. But then you look at on the weekly chart, if you look at the daily chart and you go back to here where you had that kind of extended run, we had a nice good rally, and then we were grinding after we broke out to new highs. And so expect more of a grind especially if we do get up and break it a little bit above those 29.40 highs. All right, so on the intraday chart, you see we got the new 4-week high again today at the open, and we pulled back a little into the gap, but then finished near the high at 290.47 on SPY. That's 13. This low point's going to be there for about another week or so, but that's 13 points up above, and again, that 5% mark, that kind of key number, that's 5% of the high would be 14.5 points. 5% of this low would be 13.5 points. So we're almost to that range of 5% width here, which is kind of that maximum width. Doesn't mean that we can't exceed it. It just means that, that's kind of the mature end of a move on a bullish move. When after coming up off of a significant low where the range is really wide, and then it will start to slow down, and this will really start to widen or shrink, like it did for us actually, and then it will make kind of another bullish move off of a weak intermediate posture up to new highs, and that's what we've had. We've had multiple runs now towards that 5% mark, and on this current one, we're getting pretty darn close to it. Take a look at the chart here, and you see kind of a little bit of a, whatever you want to call that type of doji pattern there, but long lower shadow. Long lower shadows are not as bearish as long upper shadows are. But there's something to keep an eye on. I mean, that means we did come down to a low point and then rallied. So the bears were there at least during the day, if not at the end of the day, right, where it's actually more significant. So that's why it's not as bearish as long upper shadows are. That's long upper shadows means the bears came in at the end of the day, where it's a lot more important. We look at the volume again, 2.21, or the range, 2.21. It filled in most of the gap. 288.21 was yesterday's close, the low today. So it came within 0.05 of a point of filling in the gap. So you see how it was pretty much an average range day to, including that really, really small gap. And the volume was right about at average too, 69 million. So when you look at that in context, that's really low relative to the 52-week range of the ATR. 69 million is really pretty low relative to the 52-week range, but it's not lower, than these lines. That's what will make them go down more. So it's not, we had a decent move. It's a bullish move, and the ATR is easily below 1% because 2.9 would be 1%. So we're entrenched in this bullish trend, and actually today you had the first drop below this 12 mark. The first time during this whole rally that we dropped below 12, since we had that October decline and rise in volatility. It's the first time we dropped below 12, and it's also the first time that we've closed the day below 85%, right? So again, you can kind of see how we finally did that back here in June, and then that kind of led to the intermediate pullback. Before we hadn't done it, then we finally broke through to the downside, not to extremes, but it finally broke through, and that led to a little pop in volatility. That was your intermediate pullback. And then we rallied back down. Then you started getting more extremes, and that led to the volatility tsunami, which is what Andrew Thrasher calls that. Very small range, very low levels here. So obviously, we're not. It didn't happen after one day, and in fact, if you take a look at the weekly for this, let's go to this a 3-year, so we can kind of zoom in here. Then again, you can see the first week last year, back here when we finished below this 85 mark. We had a couple of weeks of trading below 85, and then we had a little pop in volatility. So we might get another week or two here bullishness before we get a small pop in volatility that leads to that intermediate pullback that we've been expecting. All right, well, that wraps up our market outlook. Before we take a look at what's driving price action today and this week and our trade example, now I want to hear from you. What do you think about this outlook after going through our technical routine? Do you agree or disagree? Now's your time to vote. There's a link popping out up in the top right corner of your screen up there. Click that link, open up the poll, and vote either agree or disagree. If you click disagree, scroll down to the comment section below and let us know if there is any. Let us know if there's anything you see that would be different, that would suggest anything different than what we discussed in our so far in our market outlook video tonight. All right, now let's take a look at what's driving the price action this week. This is the week here, and you can see crude oil started the week strong, finished the week strong. Gold started the week strong, finished the week weak. So they actually finished down here. The dollar started the week weak and finished the week weak. So interesting to see the dollar didn't really rally. In fact, the dollar came back down today. Long-term bonds, though, they kind of had one of its worst weeks here. If you take a look at the weekly chart, well, let's finish everything else. The S&P outperforming IWM, EFA outperforming EEM, HYG outperforming TLT. That's a good sign. Crude oil outperforming gold's a good sign. but not, not some of these equity patterns not showing the most bullish patterns here. I like to see those small caps and emergings up here with crude oil, and that's just not what we saw this week. So not the most bullish week from a risk appetite perspective. Let's take a quick look at the week that TLT had, long-term bonds. You see it's had a couple down weeks here after kind of breaking out above 125, but also keep in mind it had a really decent move. Remember, TLT is more the 30-year, closer to the 30-year bond. And you can see the 30-year bond yield. I'll give it a second to load up here. Has rallied back up after breaking down, rallied back up to its 50-day moving average. So it's not, it's had a rebound, but it hasn't started a new bullish trend. The 10-year yield, same thing, rebounding back to that 50-day moving average. Done this before. So now the question is, are we going to break through and then fill that gap in between the 50 and the 200? That's we have to break through. And until it does, you would expect that 50-day moving average to hold at resistance until it finally does break through. So that's kind of your biggest mover. Of course, gold you saw had a down week. Again, it's been just pulling back after a nice good bullish run, and still you got the golden cross and you're still above a rising 200-day moving average. You just pulled back down towards the 50-day, and of course crude oil you see is maintaining its breakout that it's had, and it's close to getting its own on a long-term chart here, getting its own bullish cross of the 1040 weekly exponential moving averages, similar to the 50-200-day moving averages. Let's take a look at how the foreign markets did today, and we'll come over here to the grid and take a look at the watch list over here for them combined, and you can see France and China bounced back up after a drop yesterday. So did Japan. You see Germany broke out to new 3-month highs. Italy is at new 3-month highs. France is at new 3-month highs. UK is at new 3-month highs. Canada is at new 3-month highs. Still, your only decliner with the strong bearish posture and the falling moving average is Brazil. On one hand, and you can see Korea now finally turning up with a strong bullish posture and a dark green line, like you see on everything else, and everything else kind of bouncing up. So these developed markets are kind of matching what we're seeing on the U.S., and these emerging markets are still relatively strong, not breaking out to new highs, but pretty close, right? And you can actually see clusters forming on Canada and one earlier this week on Italy. So all of our recent really bullish weeks have been led higher by these, two of these three areas. You see Staples had a good week early, but, right there you had technology and communication services, and of course down here discretionary pop today. Again, thanks to areas like Disney, you had a big old pop there, and so by the end of the week, communication services, technology, discretionary, all leading. Staples also leading. Consumer stocks doing very, very well. Financials rebounding with the drop in bonds and the bounce in yields. Remember, though, take that with a grain of salt, because of the, those yields aren't trending higher. They're just bouncing higher. They're rebounding right now. And then you can see at the bottom end your safe haven areas, utilities, real estate, but you also see your dollar sensitive areas. Even though the dollar was down this week, industrials and energy lagging, and materials lagging for most of the week until catching up here today. All right, so you can see for our trade example from last night, UNH, boy, it sure got to 220 pretty quickly. That was the strike that we picked for our long call vertical. Drop down there on a low basis here today. Remember, it's got to close below 220 to get the maximum gain. And just because we're down there now doesn't mean we have maximum gain on that long vertical, because the time decay is what's going to get you up to the maximum gain. So it's got to get down here and stay down here. You also have this earnings coming up, which can reverse this very rapidly, and that's why we have a loss. So it might be an opportunity here where, because we've achieved so much of the gain, we haven't achieved total, but because we've gotten pretty decent rewards relative to what the risk was, you might be able to take some, like half the trade off now, and capture that smaller reward that was still pretty decent reward to risk ratio, and then let the rest of it ride with this earnings coming up, and see if you can get the rest of the kind of much, much larger reward to risk ratio at a maximum gain. Let's take a look at Walmart. So this is a stock that had been lagging behind the market as it's been rallying, but has joined the party this week. A nice good run the last really the last 6 out of 7 days, but the last 3 days it's kind of broken out above 100 with a nice good move. It's got the green line rising above, or dark green shading, dark green line on the moving average. If you take a look at its 3 green arrow chart, you can see again 3 green arrows and a rising moving average and relatively average volume. So it hasn't been too big, but it's relatively average for what we're seeing here. So we're not expecting a big trend to come out of this. Remember, the market as a whole is relatively mature in its bullish intermediate run. So we don't want to make a new trend trade on this as of right now per se. Let's take a look at those 3 green arrows here, and you can see they're crossing back above 0, making a run higher on the MACD, and the stochastics is back. But the bulls are in control. The 8 and 17 crossing back above the 17, the 30-day moving averages. So bullish patterns there, and you look at the Bollinger Bands. You can see we're breaking out above resistance. So there's very, very little resistance here as we move higher to hold us down. And then you look at the DMI indicators here. Here we go. You look at the DMI, and you see Walmart. Bullish patterns as well, breaking above 25 in the last couple of days with the orange line below 20. So that's the kind of pattern. Now the ADX shows there might be a trend that's still to go here, but again, keep in mind the broader market context. Let's take a look at the long-term chart for Walmart, and you can see we pulled back to the 50-day during this pullback that we kind of were hoping that the market would give us, and you can see the nice good run bounce has had today. So nice good bullish candle. Remember, the close of the Heikin Ashi is 100. We're already trading at 101.5, so we're already trading above this week's close, even if we're not necessarily at the high, but we're close. So we're getting what could be a few more weeks of bullishness here on Walmart. So again, we're not going to do a long vertical like we did in UNH. We're not speculating on a big directional move or even a trend trade. We'll just do a relatively short trade. Keep in mind here, let's go back to the Bollinger Bands, Walmart. So you have earnings coming out right before the May expiration, literally the day before May expiration. So keep that in mind as we look at May options here. We can take a look at that 100 strike that we just barely passed. Nice good round number by the 197.5. It's still really high. 58 cents is all we need, remember, for a $3 for a $2.50 wide spread, because 58 cents gives us a 30% return on risk. So I can even allow this to go up a little bit more, to new highs next week before we get filled in, to make sure that we get the price that we want, because that price gives us the probabilities that we want. Remember, the higher the price, which is what we're getting now, the lower the probability of success. So I'm going to go for a lower price and try to increase my probability of success. If this is kind of a little false breakout, then we never get filled in because we don't continue to move higher. So we'll try to increase our probabilities here by going for our target reward for a short vertical spread. Remember, you analyze that trade, set slice to break even, and set this to the chart. And remember, again, we're trying to get 58 cents, but really we just need to get 29. If we can get that first 29 as early as possible before that earnings announcement, then the better, right? We'll take it and move on. And again, it's 29 per vertical spread, and minus commissions, of course. Set that slice to the chart, and you can see where that break even is. So right now we'd have to move up a little bit higher, but essentially would nullify this little breakout that we've had in the last couple of days in Walmart if we were to get filled in, even though we'd still be holding support. So you might actually give it a little bit more room to work with. So reduce your overall portfolio risk. If you're willing to go for a bigger trade risk, like take a little bit more than the $58 loss, just to allow it to test that support that's a little bit below there. If you're gonna allow a little bit bigger of a trade risk, then you should go with a smaller than normal portfolio risk, which is what you should be doing anyway because of that earnings. Now, ideally, we'd like to get out of this before that earnings, but if we don't, that's a big risk factor heading into. So most likely you probably will be out of this before that earnings announcement, depending upon the type of move the stock makes. But regardless, if you're going to give yourself a bigger trade risk and allow it to test that big support here at 98, just below your break evens, then like say maybe you're willing to lose $75, then don't risk that same, your normal. If you risk normally 1%, then risk a 0.5%. When you put on that trade to account for that extra risk that you're incorporating into the trade. All right, well, that does us for today. As always, thank you again for watching. Everybody, remember to hit that link that's popping out in the top right corner of your screen and go to the Market Outlook forums on marketscholars.com. Open any new thread, any questions or comments you have on today's video. Reply to anybody else's thread on what you're seeing or what you think. Or you can open up a new thread on questions or comments about anything we didn't discuss in today's video. So, as always, thank you again. Have a great rest of your weekend. Remember to subscribe to our YouTube channel, hit that like button, and comment. Follow us on Twitter, and join our community on MarketScholars.com as well as on Facebook. Have a great one, everybody. We'll see you all on Monday.